All right, welcome everyone. In our study of accounting and business, we throw around terms like corporations and shareholders all the time. But today, we're going to get really tangible. We're going to look right past the balance sheets for a moment to answer a really fundamental question. When you own a share of stock, what do you actually own? And trust me, this isn't just theory. Understanding these rights is absolutely critical for making smart decisions, whether you end up as an investor, a manager, or an auditor. So let's open up this shareholders toolkit.
Okay, let's put this into a real-world context. Imagine you just clicked buy. You've executed a trade. You are now officially a shareholder, an equity holder in a company. But what did you really just buy? I mean, it's a lot more than just a ticker symbol bouncing around on a screen, right? What you've really acquired is a specific bundle of legally enforceable rights and claims on that corporation. Understanding what's in that bundle is the first step in moving from just being a passive investor to being an informed business professional who can make really sound decisions.
So let's start with the first, and you could argue the most fundamental tool in your kit, your right to a voice. Now, this is what really separates you, the equity holder, from, say, a bondholder. See, ownership without influence is, well, it's a pretty passive position. But as a shareholder, you are actually granted the power to participate in the governance of the corporation. This is a core principle, a bedrock of corporate law. What's so interesting here is how this control actually works. This isn't some informal poll or a suggestion box. It is a formal process, usually structured as one share, one vote. Now, for those of you in economics, this is the primary solution to what we call the principal-agent problem. You, the principals, the owners, get to exercise control over the agents. That's the management team running the company day to day. Your vote helps elect the board of directors, and their legal fiduciary duty is to look out for your interests. And your vote is absolutely required for huge company-altering decisions like a merger or an acquisition. So here's the bottom line, the crucial takeaway here. These voting rights are your main tool for ensuring that management is held accountable. If the board is failing, or if the C-suite is making bad strategic moves that destroy value, the shareholder vote is the ultimate way to force a change. It's the fundamental check and balance that holds the entire corporate structure together. For anyone studying business, this is corporate governance in action. Okay, so you've used your voice to make sure the company is being run well. But what's the whole point of that? Well, it's to generate profit. And that brings us right to our second tool, your right to a share of those profits. I mean, let's be honest, this is the main financial reason you invested in the first place. Dividends are the most direct, tangible way a company shares its success with its owners. Let's actually trace this through the financial statements you've been studying. The company brings in revenue, it pays its expenses and its taxes, and what's left over is the net income. That net income then flows to the statement of retained earnings. And right there, the board of directors has a huge decision to make. Do we reinvest that profit back into the business for future growth, or do we distribute it directly to our shareholders as dividends? And as you can see here, that distribution really comes in two main flavors. A cash dividend is pretty simple. It's a direct deposit into your account. From an accounting standpoint, it's a decrease in cash and a decrease in retained earnings on the balance sheet. A stock dividend, though, is a little more nuanced. Instead of cash, you just get more shares. Now, while this increases the number of shares you own, your actual percentage of ownership doesn't change because everybody gets them proportionally. As a future business leader, understanding this choice is key. It tells you something about the company. Mature, stable companies tend to pay cash dividends, while younger, high-growth companies that need every penny for expansion might choose a stock dividend instead. So why does this matter so much for your careers? Because dividend policy is a powerful signal. A company that starts paying a dividend or consistently increases it is sending a really strong message to the market about its stability and its confidence in the future. On the flip side, cutting a dividend is almost always seen as a major red flag. As a future analyst or CFO, you'll find that deciding on that dividend policy is one of the most important financial decisions a board can make. It's a constant balancing act between rewarding owners now and funding growth for tomorrow. So you have a voice and you have a claim on the profits. Great. But companies are dynamic, right? They often need to raise more money by issuing new stock. And this creates a potential problem. How do you, as an existing owner, make sure your influence and your claim on future profits don't get watered down? Well, that's where our third tool, a really critical protective measure, comes into play. This tool is called a preemptive right. Think of it as a defense mechanism against having your ownership stake diluted. The idea is actually pretty simple. It's basically a right of first refusal. Before the company can sell a new batch of shares to the general public, it has to come to you first and offer you the chance to buy enough of those new shares to keep your ownership percentage exactly the same. Let's walk through the math on this because this is where it really clicks. Imagine you own 100 shares in a company with 1,000 shares total. Simple math, right? You own 10% of the company. Now, let's say the board decides to issue another 1,000 shares to raise some cash. Without preemptive rights, those new shares get sold to new investors. Suddenly, there are 2,000 shares out there. Your 100 shares now represent only 5% of the company. Just like that, your voting power and your claim on future profits have been cut in half. That's dilution. Preemptive rights stop this. They would give you the right to buy 10% of that new offering, 100 new shares, so you could end up with 200 shares out of 2,000 and you'd still own your 10%. See how that protects you? We've covered your rights when things are going well, during periods of operation and growth. But as students of business, you have to understand risk. You have to understand the downside. So what happens in the absolute worst case scenario? We're talking bankruptcy and liquidation? Well, this brings us to the final tool in our kit, which you can think of as your corporate safety. Liquidation rights define your claim on what's left of the company if it has to be dissolved. But I want you to pay very close attention to the last part of that definition, after all debts have been paid. This introduces one of the most important concepts in all of finance for understanding risk. As a shareholder, you are a residual claimant. I want you to burn that phrase into your memory. It means you get what's left over, if there's anything left over at all. This slide shows you the pecking order, sometimes called the waterfall, of who gets paid when a company is liquidated. First in line, no matter what, are the creditors. This is your banks, your suppliers, anyone listed under liabilities on the balance sheet. Next up are the bondholders, who own the company's formal debt. And only, and I mean only, after every single one of those debts is paid in full, do the common shareholders, the owners, get whatever is left. And in a lot of bankruptcies, that amount is zero. This right here is the fundamental risk-reward trade-off of investing. Debt holders have a senior claim, so they have lower risk, but their return is capped. Equity holders, you guys, have the highest risk, but in exchange for that risk, you have a claim on all the unlimited potential upside of the business. Okay, so we've looked at each of these tools one by one, but their real power and your real understanding of what ownership means comes when you see them as a whole system, a complete toolkit that defines what it means to be a shareholder. So let's recap this toolkit one last time. You have your voice through your voting rights, which gives you influence. You have your reward through dividends, which gives you a share of the profits. You have protection for your position through preemptive rights. And finally, you have your safety net, your residual claim on the assets through your liquidation rights. This is the complete legal bundle you are buying with every single share of stock. And that leads us to one final, really crucial question I want you to think about as you move forward in your careers. A stock price, it changes every second, right? It's based on market mood, on sentiment. But a company's commitment to good governance, its discipline with capital, its respect for its owners, those are the things that build real, enduring, long-term value. So I'll leave you with this question to debate. What is the true measure of a successful company? Is it the fleeting, fluctuating stock price? Or is it a steady, unwavering commitment to honoring these rights for its owners? That's something worth thinking about.